Our next speaker is Tobin Gorey, who's the Director of Agri-Strategy at the Commonwealth Bank. Toby's had a lot of experience in commodity trading and in commodity forecasting and analysis, particularly in his times with JP Morgan in London and Alam International in Singapore, and more recently with the Commonwealth Bank. So please welcome Tobin Gorey.
Thank you, Mick. Pleasure to be here today to continue to support the Australian Farm Institute as we do at the Commonwealth Bank. So, doing well from the dining boom. This deliberately ambiguous title, does it mean we have, or does it mean we will, or is there a question mark with that? That's my disclaimer I have to put up when I do these things. Just a little roadmap on what I'll talk about then. I do look at most of these things through the prism of what we now call the dining boom. Look at a couple of areas there. On the policy front, just looking at trade policy and agriculture policy, just a light touch there. And then sort of looking at sort of more market-oriented areas of why we have or haven't done well in terms of the dining boom so far, particularly in terms of global agricultural capacity and also the Australian dollar. And then from there to talk about, how do we define our success in participating in the dining boom? Now, the dining boom idea is a very familiar idea. Graham's touched on it already. It's just that, that very large number of people who now have enough money to choose more food and better food that they did not before. Now, what really should be happening there, as we see from Australian agriculture's perspective, is that that's a natural thing that we should plug into, and we should do well from that because we are, a leading agricultural nation. The thing is, I think the perception is that we have not done as well as we should have. I think now I would question that to some degree, but there's certainly been a lot of obstacles holding us back from doing so. Now, I guess the thing with the dining boom is essentially, if you're going to succeed and sell more food, obviously it's the case. It's an export-driven thing. You're going to other markets, so market access is essential. I don't want to talk about too much about this because Justin will go through in detail shortly, but clearly trade agreements help. We've had the multilaterals. We've struggled getting multilateral trade agreements recently, and partly that's because there were just many more parties involved than there used to be. The old GATT agreements from many years ago involved far fewer parties, so it's just easy to get agreement when there's less people involved. On top of that, there's probably now fewer gains to negotiate. Again, those earlier trade agreements got through the easy stuff, where it was easy for people to agree and give up. But now it's down to the sort of the really hard nut areas where there's very strong domestic political support for particular policies, and it's very hard for the politicians to give those policies up in a trade agreement and also for them to gain enough to look like they're winners from a multilateral trade agreement. So again, multilaterals probably are the best case kind of trade agreement in terms of the broad gains, but they're just very difficult to get to an end result, as we've seen repeatedly. On the bilaterals, these are easier, obviously, because there's only two people involved. Also, there's probably, to some extent, it's easier for two people to get together where their comparative advantages overlap so much, and they can agree to actually open up their to reduce their trade barriers to one another in doing so. And we've seen many examples of that recently. We've signed free with major Asian trading partners in recent times. The thing about these trade policy victories or the increasing access to markets is they do occur only slowly over time. They are beneficial. I think we've made great strides in that, but those obstacles are still there, but coming down slowly. More broadly on agricultural policy, there are policies that aren't necessarily trade-related that do impinge upon the ability of Australian agriculture and agriculture globally to operate in the most efficient manner possible. And that's often simply because politics trumps economics in many cases. There are many circumstances where there are strong domestic political lobbies that keep policies in place. There are many examples of this. One is Thailand and sugar. Now, Thailand is actually a very efficient sugar producer. It's one of the largest exporters in the world. But it's now in a process there where they're actually forcing more farmers to grow more sugarcane. Now, this is not really what the global sugar market needs right now because prices are quite low. Now, the reason they're forcing them in there is because they have a problem with their rice policy. Their rice policy is effectively they've subsidised their farmers to actually grow rice, and now they have too much. Now, those surpluses of rice do have the potential, but eventually almost to bankrupt the government there. So they're looking around for solutions to pay out less for rice, and one of those is to shoehorn more people into sugar, and that's just tough luck for the sugar market. But those kind of policies are still around the world, and they're probably less prevalent than they used to be, simply because the EU and the US have actually taken an axe to some of their worst policy excesses, but they're still around. So those things happen, and they dog efficient producers like Australia because those policy-induced supply surpluses. But again, the benefits are slow to accumulate here, and they can flare up again at different times. Now that's just kind of the policy aspect of it. So there are headwinds in terms of trade barriers, which we're making progress on. There's agricultural policy, which seems to, maybe we do make progress, but sometimes it seems a land of 2 steps forward, 1 step back at very best. Looking now to way the markets function and so on, is the dining boom is what it requires globally is a very, very large expansion of global agriculture over time. I think some of Graham's points before were just showing that we can't really supply potential demand for food from existing resources with their levels of productivity and so on. So we need to expand our capacity to do that. Now, the thing is, what happened is if we really date the takeoff in the dining boom, so to be 2005 or perhaps 2006, when we first started to hit supply constraints in different markets. Now, the result of that was input costs shot up a long way. The energy cost is clearly not ag-related, it's global economy related. Energy prices have been very, very high for quite some time, and have really halved in the last sort of almost 12 months now, I guess. So but energy prices were very high for a long while. High fertiliser costs too. Prices shot up very, very high in 2008 as there was a surge in demand for fertiliser as well. Now those prices got up to high levels in 2008. The GFC knocked them down for a period of time, but they got back to almost those old high levels again, just driven purely by the demand for fertiliser products. The chart there shows grain and oilseed prices, and this shows a similar pattern to what we saw in fertiliser costs as well. About the time the dining boom begins to bite on capacity, prices took off. They sort of peaked up there in 2008, had an interruption because of the GFC, as just about everything else did. But then they rose, sometimes making new highs after that, and driven by demand. Now the thing about a boom can be seen in terms of its effect on prices. I think that's the correct way to think about a boom. A boom is principally about quantities and qualities. It's not really about prices. What these prices are is signals that we're pretty much short on capacity globally to actually meet this surge in demand at that time. Now, I think my contention now is that those constraints are easing. Energy costs have clearly come off. We've got a lot more energy production than we used to have. Fertiliser costs are falling and probably will fall further as capacity keeps on expanding. And also you can see there in the chart that the prices for grains and oilseeds have fallen as well. Now, if you're a cropper, obviously that's not such good news. You actually like those good high prices. But the people it is good news for is the livestock people further down the chain feeding animals of various sorts, because their profitability is being restored. Now, the thing about that is that what is happening here is that the fertiliser guys are still making quite a lot of money. They're not making super normal money like they were before. The crop guys are still making money as well, just not quite as much as before. But the livestock part of the chain is also making money now as well. And the important part about that is the whole chain is profitable for the first time in probably the best part of at least 5 years, but probably not quite 10 years. And that's a very important thing. And if the whole chain is profitable then we can actually see further expansion to meet that food demand. Just to explore the consequence of those capacity constraints were, excuse me. Sorry, the consequence of those capacity constraints is so we'll look in terms of meat consumption and meat supply. Meat consumption was growing very strongly up until about 2008. After 2008, consumption growth for chicken and pork actually slowed to 2/3 or half of what it was in the 5 years to 2008. And beef consumption globally was broadly flat after that period of time up to 2013. So that was kind of the high price there. So if we're having a dining boom and people are eating more and better food around the place, you should see quite strong consumption growth, not slowing consumption growth, which is in fact what we saw after 2008. From the supply side too, the global herds of cattle and pigs actually shrank after 2008. Again, not something that's consistent with an expansion of capacity to meet new demand. So these sort of constraints on their profitability clearly cut into their willingness to expand and also the ability of consumers to afford this food as well. But again, what we have now is, I think for the first time in some time, is the agribusiness chain is actually profitable and expansion can flow from there. I think the other sort of key private constraint we've had, in particular to Australia, is the Australian dollar. It reached up, sort of traded in the $1.10 range, which is historically high. It's down 32 cents from the peak now, so it's dropped a fair way. Now, to produce that peak, I think that's kind of, we had some unusual events to do that. The first one is obviously the mining boom, as we sold massive quantities at very high prices of hard commodities from Australia, energy and metals. That's a once in a generation event in itself. The other thing is that Australian interest rates stopped being so exceptionally low compared to the rest of the world. I mean, the rest of the world, in many of the major countries, interest rates are all but zero, and our interest rates are much lower now at 2%, but for a lot of the time, Australian interest rates are a lot higher, and all that does is for investors is it attracts them into the Aussie dollar because they can pick up so much yield from just extra interest. Now the thing is, those two events alone are highly unusual. We had the global financial crisis. We got financial and economic Armageddon almost. So we had very uber low interest rates and uber easy monetary policy. That alone is an unusual thing, as is the mining boom. The fact that you're going to have those two together, though, I'd put to you, is not only highly unusual but highly unlikely to be repeated. The case there being is that the Aussie dollar doesn't really belong up around those very, very high levels, only in very unusual circumstances does it. And our view is that really it zigs and zags, and I mean big zigs and zags, around 80 cents over time, which is a much better level, I think, for Australian agriculture. Now, rural exports are quite responsive to where the Aussie dollar is. That chart there, which is a bit of complicated spaghetti, I'll leave you to look at it later, but just to explain what's there now. The skinnier line, as you can see it, is Australia's rural export volumes, and that's a deviation from trend over time. So it's just a very simple trend from about the time we floated the Aussie dollar. And that obviously goes, and so when that line's above the line where our exports are growing faster than usual and below, and it's growing slower than usual. The thicker line is the Aussie dollar's deviation from its purchasing power parity value. Now that's also a measure of sort of over or undervaluation of the Australian dollar. And as you can see, in broad sweeps, those two mirror one another. So when we're growing export volumes, the Aussie dollar's low, and when our export volumes are shrinking, the Aussie dollar's relatively high. Now, so we've had a big fall in the Australian dollar now. It's been at a very, very high level, which is always going to crimp rural exports, and now it's come back down again and starting to do that again. Indeed, anecdotally, as I talk to people, as I travel around Australia, there is signs that people are re-entering export markets that hadn't been there for a couple of years, and a lot of that is simply to do with the price point being lower because the Australian dollar is actually lower. So just to summarise on what I've said there in terms of, we've had quite a few obstacles to overcome to actually achieve our participation in this dining boom. Our market access is improving. We've had several trade deals already, and the benefits of those are still to come. Agriculture policies, sporadically they become a problem, but I think they remain a fact of life, so it's not clear we're making much progress on those insofar as we need to. From the private side of it, though, agribusiness capacity has expanded very, very substantially in the last, or especially the last couple of years, and so that profitability along the agribusiness chain is now returning. So as a result of that, people will be more willing to invest again. And the special one for Australia is the Australian dollar has fallen very, very substantially in that time as well. Now, the thing is, so given that substantial progress on these issues, I expect to see more success in terms of participating in that dining boom in the period ahead. Now I think that is actually just to add to the success that we've actually already had. I'm not quite sure I agree, and to be a bit contentious and to respectfully disagree with Graham as well, is I think we've actually done rather well out of that thing. This is a point that Graham made another way as well. This shows the developing and emerging nations' share of broad categories of cross-border physical trade in agricultural products. Now, the emerging nations have clearly gained market share over time. I don't really find that surprising, to be honest, and it predates this dining boom days anyway, but it may have accelerated from after them a little, but even that's contentious. But still, it's unsurprising. Most of the underutilised ag capacity in the world exists in these nations because they're poorly farmed, or they don't have enough capital applied to them, or there's other policy restrictions that don't allow them to actually be farmed correctly. And also the produce from it to be handled correctly and exported elsewhere. So the biggest gains when you see a price rise should be in the place where there's the easiest gains in capacity utilisation. Now, Australia's share of global trade has actually fallen. This is Graham's point again. This is, again, numbers in a slightly different way for those same broad categories. But I think that's actually common to all the advanced economies. It's not a particularly Australian issue as such. Now, the question is that a problem or a sign of failure? Perhaps it is, but I'm going to put just a slightly different view on that to you. Losing share is an issue if the volumes are stagnant, right? Because clearly, if you are losing market share in a stagnant market, your sales are actually declining, or your exports are actually declining. The thing is that's not true. Australia's export volumes have actually expanded by a bit under a third since 2005, which is rather well. And the other thing is also that global agricultural trade has actually expanded by, depending on which category you look at, it probably averages around about 30%, perhaps a third. Some categories are a bit small there, as that chart shows up there as well. So what we've really got here is we've got a smaller share of the pie, but it's a bigger pie. So we're actually what we're feeding on is actually larger than it was before, which I don't think is actually a bad outcome at all. So, to the contention that we should do well out of Australia, out of the dining boom, I think that's true, but I think we can say we have to some extent, particularly given some of the obstacles in our way, and particularly just the capacity constraint issues, which there are still a few around in Australia, but also particularly the Australian dollar coming down as well. Now, we can't be Asia's food bowl. We know we just don't have the space to do that. So I think judging our success on gaining market share is I think it's a wrong measure. We are going to lose market share almost as a given, but it doesn't mean we're not being successful in doing so. So I think what we would need to do is look for a better measure of our success, and a share of global trade is a game we're not going to win. Perhaps we need to think about what our volumes are. But the thing really most importantly is, from a business perspective, is you need to be able to participate in this profitably. And I see and meet a lot of people who are actually doing exactly that.